As we've been waiting for the Federal Reserve to start reducing interest rates after 2 years, we're now seeing signs that the first cut is finally imminent. According to a recent report, the odds of seeing a cut in September are now at 90%. And while interest rates have remained high, many of the higher-yielding asset classes have gone through serious share price declines. That's despite the vast majority of these investments still performing very well, with only a minimal number of them going through dividend cuts. But once we start seeing rates go down, the following investment types should start seeing share price appreciation, or at least return to their fair value. The first investment type that'll experience a good recovery, potentially the greatest recovery, will be equity REITs. These are companies that own and operate income-producing real estate. The reason these companies fall in share price when interest rates rise is because they regularly borrow large amounts of money to grow their property portfolios. REITs are required to pay out 90% of their earnings to shareholders in the form of dividends. As a result, these companies don't have to pay corporate taxes, but that also means they don't have much money left over to do things like acquire more properties. As a result, these companies will take on debt if they want to grow their properties or if they need to renovate or upgrade their existing properties. With interest rates being so high right now, many REITs have been avoiding taking on a lot of debt because that would significantly increase their debt expense. So we've seen a lot of REITs do one of two things over the past couple years. They've either slowed down their growth, which investors don't like to see, or they've issued more shares of their stock, which also causes their share prices to typically fall. But now that we're close to seeing the first interest rate cuts, we should expect to see investors become more bullish on the equity REIT sector. We've already seen the REIT sector climb this month, indicating optimism. The Vanguard REIT ETF, ticker VNQ, has climbed about 7% this month, with most of that growth happening in just the last week. I'm expecting this optimism, although not 7% every month, to continue when we first see cuts. To give some examples, Agree Realty was close to $80 per share before interest rates really got to be as high as they are today. Another example, of course, is Realty Income. Their stock reached about $75 a share in 2022, and since Q1 2022, the real estate portfolio has increased 86% and continues to post record profits. Vici's another stock that's been an extremely lackluster performer over the past couple years, but they've since recently exploded in terms of growth over the past couple weeks. Much like their equity counterparts, mortgage REITs are also likely to rebound to some degree. These companies issue and/or purchase mortgages and mortgage-backed securities. Mortgage REITs earn money on their net interest margin, and what that means is the REIT will borrow money which they have to pay for and then use it to buy mortgage investments. The goal of these MREITs is to earn more from their interest on their mortgages than what they have to pay for in interest to take out debt. And since these mortgages don't usually offer high interest, most MREITs use a lot of leverage to try to boost their returns. Just like equity REITs, they're also required to pay out 90% of their earnings and have some of the same problems with growing their portfolios. As you can probably imagine, a rising interest rate environment is more challenging for these companies compared to equity REITs. Using margin when the market is falling magnifies losses, and many of these companies have been reporting losses in interest income and their net asset values. When debt becomes less expensive to take out, then that should increase the profits that these types of companies see. However, if you've been watching my channel for a while, you'll know that I don't usually like MREITs, with just a couple of exceptions. When times are bad, they're usually exceptionally bad, and they have a hard time recovering back to their original share prices during good times. Nearly all MREITs experience share price and dividend declines as time goes on. But even though I personally don't like these investments very much, I won't deny that they are likely to perform much better when we see rates get cut. Annaly Capital is the biggest MREIT out there, and its share price has actually remained pretty flat as of recently. But for the past 12 years, this stock has done nothing but cut its dividend. Once interest rates get reduced, then that should result in more profits for them. They're dangerously close to having to go through another dividend cut again, but this stock could see a decent run-up in share price after rate cuts. Another example is AG&C, which is another MREIT that has slightly better performance than Annaly. This stock should also see better returns when we see interest rates get cut. But I still have serious doubts as to whether most of these MREITs can do well going decades into the future. The next investment type to likely see growth will be closed-end funds. However, this only applies to certain funds, such as those that hold fixed income investments and large expensive assets. It's well known that when interest rates rise, investors tend to lose interest in these kinds of investments, so bonds and other fixed debt assets go down in value when interest rates increase. When rates are cut, then investors become more interested in these kinds of fixed investments again. For example, a lot of the PIMCO funds hold these fixed income investments, such as emerging market bonds, commercial MBSs, agency mortgages, and corporate debt. But on the other hand, some CEFs won't become more appealing when interest rates get cut. In the past, people have asked me about these floating rate closed-end funds, such as the Naveen Floating Rate Income Fund. The dividends that these funds pay are directly tied to interest rates, and you can see that in this instance that it's been paying more when rates have been increasing. Once we start going through cuts, then both the dividends and the share prices of these CEFs will go down. These are definitely cyclical investments that really aren't ideal for buying and holding for many years or decades. A different type of investment that are technically closed-end funds, but I usually like to put them in their own category, are CLO funds. These are investments that hold collateralized loan obligations, which are pools of leveraged corporate loans that are bundled together and put into equity securities. These investments offer exceptionally high yields because these funds buy some of the riskiest securities out there. These types of investments are another area where we could see better performance when rates get cut. According to this chart, which is the Credit Suisse Leveraged Loan Index, you can see that after the 2008 financial crisis and interest rates were cut, CLOs performed exceptionally well. There's no guarantee we'll see these kinds of returns this time around, but the CLOs that these funds hold will likely perform better with lower interest rates. There are currently 3 CLO funds that exist, which are Eagle Point Credit Company, XAI Octagon Floating Rate and Alternative Income Trust, and also OFS Credit Company. All 3 of these investments don't have great track records in terms of performance, but just like with REITs, they are likely to see some degree of rebound for some time. The companies whose debt is inside these CLOs should face less pressure as debt becomes less expensive. Finally, one more investment type would include companies and funds that are very infrastructure intensive. This is more of a broad category as it expands across several different investment types. For example, REITs that own cell towers, which are very expensive to buy and maintain, will have an easier environment to operate in. There's also closed-end funds that hold both infrastructure companies and assets. This would also include utilities, as these also cost a lot more to maintain, and companies that own utility assets regularly borrow to build and maintain them. Examples of infrastructure and utility funds would include the Reeves Utility Income Trust, ticker UTG, and the Cohen & Steers Infrastructure Fund, ticker UTF. Just like everything we've looked at up to this point, as soon as rates start going down, then these companies will be able to grow at a much cheaper rate compared to 2 years ago. Both of these closed-end funds are still down from 2022, which is when interest rates again started to really take off. But I have to make things clear that how much growth these investments see all depends on how quickly and how much rates are cut. If the Feds cut rates in September by just a tiny amount and then they don't cut them any further for months or even a year or longer, that likely won't result in a great deal amount of growth in the aforementioned areas. But every sector I mentioned should see better performance as soon as rates finally start going down. It's been speculated that we won't see interest rates get cut all the way down to zero, but that won't be necessary in order to see an impact on the share prices of these higher yielding investments. So with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.